Hey guys, and welcome to today's video. So the goal of every trader is to stay consistent and profitable in the Forex financial market, either on a weekly basis or on a monthly basis. So in today's video, I'm going to be sharing some few tips I believe that when you start incorporating to your trading, is going to improve your consistency and profitability on the short term and also on the long run. So these are the few things I believe you need to focus on or start incorporating your trading that's going to help you. The number one thing is you want to trade in line with the higher time frame institutional order flow. I know most of us have heard this, and it's more like becoming a more like a cliche. You understand? But when I'm actually referring to the higher time frame, I'm actually referring to the monthly time frame, which is in this case on the dollar index is something like this. On the weekly time frame, which is the second time frame on my own class of when I refer to the higher time frame, and the last of all is the daily time frame. So which will eventually look like something like this if you are trading the dollar index. So you want to trade on one of these three time frames, and as a trader, you want to have at least three time frames you are looking at to be able to make your trading decision, to be able to make better trading decision in the forex financial market, depending on your trading style. So let's take, for instance, you pick the daily time frame to be your highest time frame. That higher time frame you want to trade in line with its institutional order flow. Then you want to look for a intermediate time frame and your execution time frame. So the intermediate time frame relatively to the day time frame could actually be the 4 hour or the 1 hour, depending on how frequent you want to catch your trades. Then your execution time frame will be the 15 minutes. Then if you pick the weekly time frame, probably as your higher time frame, where you're going to key off your institutional order flow from, then you want to use the 4 hours as your intermediate time frame, and you want to use the 1 hour for your execution, or probably sometimes the 15 minutes. Then if you are looking at the monthly time frame to key off your higher time frame objective for institutional order flow, then you want to look at the daily for your intermediate time frame objective, and you want to look at the 1 hour to or 4 hours for placing your trades, which will be your execution time frame. So these are the ways you can blend the one of the body. The characteristics or the framework of working with intermediate time frame is you want to use a 4 to 6 ratio in terms like take for instance the daily to the 4 hours simply means it takes 6 candles in the 4 hours to create one day. So you want to use a 6 to or 4 ratio. You understand? For the 1 hour to the 4 hour, it takes 4 hours to create it takes 4 candles on the 1 hour to create a single candle on the 4 hours. So that's the kind of ratio you want to work within. So when you're defining your time frames, you want to say when you're talking about the three time frames you should be operating on, and I'm going to bring out a video especially on time frames, how to define time frames and how to work within time frames. But now let's just look at an example. Let's take for instance we choose the daily time frame as our higher time frame objective, or we are keying off the institutional order flow. Like let's just look at a very quick example right here. So right here we saw the dollar index push up right here, taking out this old high. So let's mark that out in time right here, being taken out over here. So you can see dollar index taking out this area. So now prior before this swipe up right here, we can see there's somewhat like a swing high right here. You understand? So we saw price take out this area, and there's a kind of swing after this candle was formed, and we saw price going higher again, clearing out this high and this high. This is a double high over here that price came for, and later on we saw price drop down, taking out this low. So now this is a break of structure, indicating that there have been an institutional market structure shift on the daily time frame. So in other words, what this particular move to the downside tells us is that the institutional order flow is now bearish to the downside. So you want to go in from the next candle to start looking for how to frame your bearish objectives. You want to say in the forex financial market, which is on the dollar index. So I can choose either the 4 hour time frame or the 1 hour time frame, depending on how frequent I want to be able to pick my entries. You know what I'm saying? If I want to be looking at the chart all the time, every 1 hour, then I'll use the 1 hour. If I want, and but that will also help me get precise entry and limits my risk to reward. But if I want to use the 4 hours, I want to be looking at the chart every 4 hour, then the 4 hour will be the opinion for me. So let me just go with the 4 hour. to keep things nice and clean. But mind you, the ratio of choosing this thing is a ratio of 4 or a ratio of 6. You understand? So price, this is that swing low from the daily right here. Price expanded to the upside, taking out those highs. Now price came down, breaking structure right here. Very clean institutional market structure shift. And we can see that clearly all the way from the daily. So the institutional order flow is bearish all the way from its higher time frame. So we want to trade in line with that institutional order flow. So this is the next day, and we can see the 4 hour candles pushing up. We are not moved by all these things. Why? Because we already have a objective all the way from the our higher time frame institutional order flow, which is bearish. So what we're looking for is bearish ideas. And you can see that from this candle right here, price started giving us bearish ideas right here. And on this particular candle, this is a swing high right here. And this is the fourth candle. So you want to count 1, 2, 3, and 4. On this fourth candle, you can confidently enter a sell right here. You understand? And hold it up down to this particular low right here. So this is a concept right here, a concept for entry. You understand? When you have a swing high, you want to count 1, 2, 3, and 4. For instance, now there's no somewhat like a structure right here that you can use to key off, but there's actually a swing high, and you can use the fourth candle right here to get an entry, and that's what we did right here. So you get an entry from here, and you exit right here, and you can see you wait for price to actually come up again. Um, if you use your Fibonacci right here, you can see price came into the 50% level. That's the um, premium level right here, and you can see on this swing high right here, 1, 2, and 3. On the fourth one, you can get an entry right there on this candle, and you can actually exit at the bottom right here. You know what I'm trying to say? And that's how you're going to keep doing that till you get to this particular objective that we have right here. So that's one way you can actually use to improve your trading and staying in line with the right direction of the decision order flow all the way from the higher time frame. And the more you do this, you're going to improve your trading results. That doesn't mean you're not going to have losing trades, but the truth is that you're going to always be on the right side of the market. And when you're on the right side of the market, you are helping the market fulfill its needs. And when you're helping the market fulfill its needs, the market will eventually pay you. You know what I'm saying? And so that is the concept behind this whole um, tip, the number one tip. So the second tip is that you want to avoid picking tops and bottoms, especially in opposite direction of the trend. So now let's look at the Euro USD for that example. Like now you can see all these brown areas or shaded areas on the chart. Those are the opposite direction of the trend. So if I ask anybody looking at this trend, even though a beginner can actually tell me that so far so good, the Euro USD have been on what, a downtrend. You understand? We've been on a downtrend, on a downward slope. So these are all bearish moves all the way from July 2021 right now to where we are currently in price, September, October in price. So the whole move to the in the euro is has actually been a bearish move. You understand? What you don't want to do in this kind of market condition is to be catching bottoms. Why? Because every bottom you are trying to catch, you understand, you are at your winning rates at catching bottoms in a trend like this is only 10%. You only win 10% of the time, but lose 90% of the time. And if you are trying to have a winning edge with this kind of counter trend strategy, on this kind of market condition, you always lose. You know what I'm saying? Because the house will always win. Because the house, being the Euro USD in this context, is actually going for bearish prices, not bullish prices. So rather, in this kind of market condition, you want to focus on catching tops. You understand? You don't want to focus on bottoms. You understand? You want to avoid catching the bottoms. You understand? So the second tip you want to have at the back of your mind is avoid catching tops and bottoms, especially in opposite direction of the trend. So the opposite direction of this trend is the bullish side. You understand? The bottoms. So you don't want to focus on catching bottoms. You want to focus on catching the tops. You understand? And no matter any top you catch here, you're always going to win. You understand? No matter any top, you understand? You're only going to lose 10% of the time and gain 90% of the time. Take for instance now, you catch this top right here. At least you'll be in profit, but you got knocked out. Good. Now you enter another top right here. You win to the downside. Is that not so? And that's the way it is. You get, so let's say you get out at this area, price goes up again. You ignore this bottom, you enter this other top right here. You win all the way down to this point. You get it now. Okay, let's say you enter this top, you lose again right here because the market went against you here. Okay, you enter another one again, you lose. So this two losing streak. But when you entered on this one, you keep winning to the downside. So that is how to um improve your trading and stay profitable on the long run and also on the short run. You want to say in this kind of catching the tops in a bearish market tone, you're going to always win 90% of the time and lose 10% of the time. But when you're trying to catch bottoms in a trend like this, which is a bearish trend, you're going to lose 90% of the time and gain 10% of the time. So you want to take that into account to improve your trading. And the last of all we're going to be looking at in this video is you want to wait for price to create a support or resistance in line with your institutional order flow. Now, what do I mean by that? Now, let me just give you a quick example, like a trade I picked with the Euro USD on the daily chart. So I'm going to create this for you. So now when I talk about institution support and resistance, I'm not talking about the classic retail mindset approach. You understand? I'm actually referring to institutional reference points. You understand? So let's say, for instance, now if you look at this particular area, this was a trade I picked last 2 weeks. You understand? This was a trade I picked last 2 weeks. You can look at this area now. There was an institutional market structure shift when price took out this particular high right here, as you can see, and price expanded to the upside. So this was an expansion. I just saw the price was retracing here. What can you see right here? This is a what? A bullish order block. So what I did was I drew this bullish order block out in price right here. So I saw this candle close atop this particular bullish order block right here on this down close candle. And on the next day, which was on this candle, I was anticipating a bullish run to the upside, actually also taking into account this resistance already from the in terms of this order block, this bearish order block. So I was taking into account this on the daily time frame, also taking account to this particular area of entry. And what do? I waited on the hourly time frame right here, on the hourly time frame, and this was my trade. So let me bring the period separator so I'll explain that particular trade for us. So right here, I just all I did was I waited for the London session. So London session on chart time came in around 10. You understand? 10 chart time. If you look at the downside of the chart around this particular area, you see what I'm talking about. Came in around 10 o'clock chart time. So that was London session. Mind this is the Euro USD. So I saw this expansion to the upside. So if I zoom that in clearly, you're going to see what I'm talking about. So I saw this expansion all the way to the upside. Mind you, I'm keying off the support of the bullish order block all the way from the daily time frame. I'm trading also in line of the institutional order flow from the daily time frame. I've seen price create a support, supporting that institutional order flow, which is a bullish order block. And I'm waiting for price. Once I saw price lean on it, I want to see price start keying off its supports from that area. And that's what I saw on the London session on this particular day, on the 20th of October. You can see, and price expanded to the upside, breaking structure right here. And I saw this retracement. So this was my entry. So I bought all the way right on this particular candle and I exited a trade. So this gave me at least 6% on my trade. Now I say this particular trade from this low to this particular high, because I framed my risk to reward properly. So you can see how price expanded on the upside, came back into where a fair value gap right here. So this is a fair value gap. So this was a reason to enter the trade here. Right. If I go down to the 15 minutes, you're going to see more precise entry. Let me see if I could do that right now. So you can see it right here. You can see price expanded to the upside. Price came down into where this fair value gap right here. You can also see the fair value gap on the 15 minutes. And if you enter on this particular area, I exited on this particular high right here. And this was a 6% trade right here. Just following these three principles, these three tips that I'm actually sharing with you today. So I believe if you incorporate these few things in your trading, into your trading plan, or adjust your trading plan in line. Don't trade something that's outside your plan. All these tips are just meant to for you to improve your trading plan. I can tell you your results is also going to improve. You're going to stay consistent and you're also going to be very, very profitable on the short run and also on the long run. So I want you to note this very, very all important tip. Your goal as a trader is to be able to keep more than you lose. You understand? So your goal as a trader is not to milk the market from tops to bottom. Your goal as a trader is to be able to keep more of your funds. You want to say keep more of your profit than you lose. You want to say you want to keep more of your capital, keep more of your profit than you lose. You get what I'm trying to say? And if you follow these simple tips, I can assure you that your trading result is going to improve radically. So I hope you find value in today's video. Hit the like button, hit the subscribe button, and see you in another video.